You did everything right. You studied hard, got the degree, landed the job with the salary that was supposed to change everything. And for a while, it felt like it was working. You got the raises, you got the promotions, you upgraded the apartment, the car, the lifestyle. But then something strange happened. No matter how much more you made, you never seemed to get that much further ahead. The number on your paycheck kept going up, but the number in your bank account never seemed to follow. And now you're sitting there wondering, if I'm earning more than I ever have, why does it still feel like I'm running in place? Here is what nobody told you when you were chasing that salary. The paycheck was never the destination. The paycheck was the trap. And the people who are actually building wealth, the ones whose net worth doubles while they're on vacation, they figured out something that changes everything. They figured out that income is not wealth. Income is just cash flow, and cash flow disappears. Wealth is different. Wealth stays. Wealth compounds. Wealth works for you while you sleep. Today, I want to show you the exact mental shift that separates the people who earn a lot from the people who keep a lot. I'm Julia, and by the end of this, you're going to see your salary completely differently, not as a goal, but as a starting point, and maybe, just maybe, as something you eventually won't need at all. Let's start with the uncomfortable math. When you earn $1 from your job, that dollar never actually arrives whole. The government intercepts it first. Federal income tax takes a slice. State tax takes another. FICA, Social Security and Medicare, takes its cut before you even blink. By the time that dollar reaches your bank account, it might be 60 cents, sometimes less. Now here's the part that should make you furious. When a wealthy investor earns $1 from an asset they've held for over a year, a stock, a rental property, a business, they pay capital gains tax, not income tax, capital gains. Which in most cases is half what you pay on your salary. Same $1, completely different tax treatment. That's not an accident. The tax code was written with a philosophy baked into it. Labor gets taxed heavily. Capital gets taxed lightly. Work for money, you lose. Own assets that make money, you win. This is the fundamental equation that most people spend their entire lives never understanding. But let's go even deeper, because the capital gains rate is just the beginning. The real secret isn't about paying less tax. It's about legally deferring tax almost indefinitely. And to understand how, you need to understand one concept that will change the way you see money forever. The concept is called an unrealized gain. Here's how it works. Let's say you buy shares of a company for $10,000. Over the next 5 years, those shares grow to $50,000. You have made $40,000 in profit. But here's the thing. You haven't paid a single cent in tax on that profit because you never sold. The IRS cannot tax you on money you haven't received. That $40,000 sits inside that asset, compounding, growing, building, completely untouched by the tax system. This is what billionaires live inside of, not income, unrealized gains, paper wealth that grows tax-free year after year after year. Now you might be thinking, okay, Julia, that's great, but if all their money is locked up in stocks and they never sell, how do they actually live? How do they pay for the houses and the travel and the schools and just regular life? This is the part that rewires your entire brain. They borrow, not because they're broke, not because they need to, but because borrowing is the single most tax-efficient way to access wealth that exists. Here's the mechanism. You go to a bank. You say, I have a $5 million portfolio. I want a $2 million loan against it. The bank says, absolutely. Low interest rate, done. Those $2 million land in your account. And here is the magic. A loan is not income. The IRS does not care about loan proceeds. You don't report them. You don't owe taxes on them. That money is completely invisible to the tax system. So now you have $2 million to spend however you want, and your portfolio is still sitting there, still compounding, still growing at 8 or 10% a year. Meanwhile, you're paying maybe 3 or 4% interest on the loan. You are making money on borrowed money. That's called arbitrage, and the wealthy do it constantly. Think about what that means for you and me. We earn $1, we lose 30 to 40 cents immediately. We try to invest what's left. They let their dollar compound untouched. Then they borrow against it at low rates. They live on that borrowed money tax-free. We are playing the same game, but with completely different equipment. Now, the question that's probably sitting in the back of your head right now is, doesn't that debt eventually have to be paid off? What happens when the bill comes due? This is where the third piece of the puzzle comes in, and it is the most extraordinary part. It's called the step up in basis, and it happens at death. I know that sounds heavy, but stay with me, because this is the part that makes the whole system click into place. When a wealthy person dies and leaves assets to their heirs, something remarkable happens inside the tax code. The cost basis of those assets, that's the original price they were purchased for, gets reset to the current market value. Let me show you what that means in practice. Your grandfather bought stock in a company 40 years ago for $1 per share. Today, that stock is worth $300 per share. If he had sold that stock the day before he died, he would owe capital gains tax on $299 of profit per share, but he didn't sell. He died holding it. When you inherit those shares, the IRS treats them as if you bought them for $300, today's price. All of that accumulated unrealized gain, decades of compounding, just disappears from a tax perspective. You can sell immediately and pay zero capital gains tax. So here's how the cycle completes itself. The wealthy person lived their entire life borrowing against their portfolio to fund their lifestyle tax-free. When they pass, the heirs inherit the portfolio with a stepped-up basis. They sell a small portion to repay the loans. They pay no capital gains because the basis was reset. The debt is gone, the wealth remains, and the next generation starts the cycle again. Buy assets, borrow against them to live. Die and wipe out the tax liability. It is the most efficient wealth transfer machine ever embedded in a legal system, and it is completely 100% by the book. Now, I can already hear what some of you are thinking. Julia, this is great for the ultra-wealthy, but I don't have a stock portfolio worth millions of dollars. I can't just walk into a bank and ask for a multi-million-dollar credit line. You're right, not yet. But here's what you can do right now, at almost any income level. Start understanding the difference between a liability and an asset. A liability takes money out of your pocket every month. A car payment, a subscription, a lease on something that drops in value. An asset puts money into your pocket, or grows in value, or both. Every dollar you redirect from buying liabilities to buying assets is a vote for your future self. An index fund is an asset. A rental property is an asset. A piece of a business is an asset.
Start there. Start small, but start. Because here's the second thing you can start applying immediately. Stop treating debt as the enemy. This is going to feel counterintuitive because we were raised to believe that debt is failure. Pay it off. Get out from under it. Be free. But there is good debt and there is bad debt. Bad debt is borrowing money to buy something that loses value. A car you can't afford, a vacation on credit. Clothes, gadgets, experiences that evaporate and leave only a monthly payment. Good debt is borrowing money to own something that grows in value or generates income. Good debt makes you richer over time. Bad debt makes you poorer. The wealthy carry almost zero consumer debt, but they carry enormous amounts of investment-backed debt. They leverage assets to acquire more assets. They use the bank's money while their own money compounds. This is the concept you need to tattoo on the inside of your brain. There's a third mindset shift that might be the most important of all. Stop measuring your wealth by your income. Start measuring it by your net worth.
Income is a number on a paycheck. It's temporary, it's taxable, it stops when you stop working. Net worth is the scoreboard that actually matters. It's the total value of everything you own minus everything you owe. And here's the thing about net worth. It doesn't care if you worked this week. It doesn't care if you took a vacation. It doesn't care if you were sick for a month. It grows independently of your time. It compounds independently of your effort. That is true financial freedom. Not a high salary, not a big bonus. Assets that accumulate value whether you show up or not. I want you to think about something that most financial content never addresses. The reason the wealthy stay wealthy across generations is not because they're smarter than you. It's not because they work harder. It's not even because they got lucky more times than you did. It's because they were taught a completely different definition of money. You were taught that money is something you earn. They were taught that money is something you own. You were taught that the goal is a bigger salary. They were taught that the goal is a bigger asset base.
You were taught that debt is dangerous. They were taught that the right debt is one of the most powerful tools in existence. These aren't just different habits, they're different mental operating systems. And you can download a new one starting right now. The path isn't complicated, it's just uncomfortable at first, because it requires you to delay the lifestyle upgrade and redirect that energy into ownership. It requires you to look at an index fund instead of a new car. It requires you to think about cash flow and compounding instead of what your paycheck looks like. It requires you to be patient in a world that is constantly selling you the idea of immediate. But here's what I promise you. The people who make this shift, who go from income-focused to asset-focused, don't just end up richer, they end up free. Free from needing the job, free from needing the raise, free from the anxiety of what happens if the paycheck stops. Because when your assets are large enough to borrow against, you no longer need to sell your time. You have built the machine, and the machine runs without you. That's the real goal, not a better salary.
A life where your money does the working and you do the living. The tax code is a map of what the government wants you to do. Invest, and it rewards you. Build, and it rewards you. Work a job and spend everything you earn, and it taxes you first and rewards you last. Stop fighting the current.
Learn which way it flows. Then build your boat and sail with it. Your future self is waiting on the other side of that decision.